Hey traders, welcome to Charts and Coffee. Great to see everybody. Happy Tuesday. Hope everyone is doing well. First thing we got to talk about here this Tuesday, gang, is coming up at 10 a.m. Both today and tomorrow are the what they used to be called the old Humphrey Hawkins testimony. This is where Jerome Powell will be speaking in front of today, the Senate Banking Committee, and tomorrow, the House Financial Services Committee. And of course, he's going to be peppered about the economy. He's going to be peppered about monetary policy. And of course, that's going to include the status of their plan for rates. Now, anytime Powell is in front of the mic, he's going to be televised. It's really not a matter of what he's going to say. It's going to be a matter of how it's perceived. And if we take a look, there is a magic decoder ring I want to make sure everyone has for this event. It's really simple. It's the Fed Fund futures. So when he's done talking, and this is the bigger picture macro, when he's done talking, what we'll be able to do is see here what expectations for September are like. In fact, it's really going to be worth our while right now if you want to jot this down, and I'm going to do that right now. Jot down here what September probabilities for a rate cut are. They're 71.8%. That then means the spillover into November is 51.2% expectation that will cut in November, not in September, but there's a 33% chance that in November we'll get our second cut. So we want to see those columns that are either the 500 to 525 or the 475 to 500 columns get taller, because that then increases expectation on cuts. Now, we're still talking about year end, but frankly, as we get into the second half of this year, we really need to be talking about the first half of next year, because the market is a forward-looking machine, right? It's always looking ahead. Bonds are always looking ahead. The reason the equity markets are rallying is they looked ahead since Q3 of last year on the Federal Reserve's rate cuts. And that's enough. We don't have to get the thing to be happy about it, right? The markets are funny that way. They don't have to get the rate cut to rally the stock market. Just the anticipation of is enough. So we have to map the anticipation of. And sometimes, when I look at what we do as traders, we're not economists. We're not talking about, frankly, in all due respect to fundamental folks, we're not talking about PE ratios and things of that nature. That's not what it is. It's perception of all those things. And the further we get away from that notion of what is the market perception, what is their expectation, we're going to be fine. We just follow the trends. We don't question whether or not NVIDIA or semiconductors or Apple should be up here. We just say that it is, right? That's it. So I don't know how many folks keep thinking, oh, we're going to rally for a little bit longer and then we're going to pull back in summer. Why? Because sell May and go away works so well, right? So those are things we need to ask. It just is. And so remember, as long as we track the thing that is causing the uptrend, we'll be fine. That's expectation for rate cuts. So today and tomorrow, 10 a.m., heads up. If you're a day trader, put your helmet on, grab some Dramamine. It could be a wild one. And if you're a swing trader, the window for swings will open up today after, for me, the swing trading window will open up after he's done talking, because usually day two is a rehash of day one. So day one is the really important one that we want to keep our eye on. All right. So that is how we want to measure it. And by the way, if you say, Rog, what is this? Go to the all-knowing, all-seeing Google. By the way, I've been using Perplexity a whole lot more than I've been using Google. I love searching with that. That's been a whole lot better for me. But anyways, if you go to Google and search CME Fed Watch, it'll bring you to this link. Okay, as always, let's make sure we're keeping an eye on what's going on in the broader averages. Not all the broader averages are created the same, and nor are they moving the same. The S&P, the NASDAQ continue to be the leader. In fact, I wouldn't even say the S&P is up here of its own accord. It's up here because it's coattailing, right? The NASDAQ walked by the S&P and said, kind of like, who's watched The Last Dance? When Jordan came back to a new crew for their second run of 3 championship rings, I think he looked at one of the players and said, "You ready to jump on the Cape?" That's what the NASDAQ did to the S&P. The NASDAQ looked at the S&P and said, "Are you ready to jump on the Cape?" And it did. And so the weighting of the NASDAQ that's looking more like the S&P that looks more like the NASDAQ, your magnificent sevens, right? Your technology, semiconductors, etc. That's why the S&P is keeping track with the NAS. When financials kick in, and we'll know better going into next week if that is in fact going to happen, because on Friday we get the earnings season kickoff with those financials. If financials can start to keep pace, now the S&P has a cylinder of its own that's independent from the NASDAQ that could help propel it in a way separate from tech. And by the way, that'll help the Dow too. So we're going to keep an eye on that this week. So there's a lot going on this week, gang. All right, next up. Next up is data. We do have PPI and we do have CPI numbers this week, CPI being the far more important one. Even though the Federal Reserve doesn't use the CPI as a model, we use it as a harbinger to inflation. They use the PCE, but any data, PCE, CPI, is going to be yet another needle mover for expectations. We need to see that data flat or cooler to keep expectations up for September, November, and December. All right. So if you're a bull, right, if you've got a bullish thesis and that's what you're trading based on what you see, you want a cooler or flat, definitely cooler, but flat CPI. Now, if you're one of those folks that think we're cruising for a significant pullback, I'd say be really cautious. But anything Powell might say today and anything that the CPI might indicate that inflation's hotter would be that reason, because it would unravel the expectation for that September quarter point cut. All right. So always go back to the data, gang. It's never what we think. It's certainly not what we feel. It's what we see. And sometimes it's really hard just to say, this is just doing that. I don't have to like the reason. I don't have to even believe in the reason, but it is what it is, right? Okay. So in terms of rate cuts being priced in, yes, but not fully, right? We have, and yes, they are, of course, are slowly, incrementally being priced in. So priced in would be another way of saying, is it fully discounted? I would not say, editor, that it's fully discounted. The reason I say that is when we look at the track of clarity to each one of the cuts, for example, the hold is discounted, right? The fact that we're rallying right now has nothing to do with July 31 meeting expectations. That is 95.3% hold. So that's discounted. And anything over 80 could be kind of quote unquote fully discounted. I've always found that phrase funny, fully discounted, that you hear on television, although I find most of what they say pretty funny. We don't know what everybody thinks, but once we kind of Pareto principle it, once that 80% is there, that's pretty much what the Federal Reserve says. Oh, the broad majority of market participants expect us to do this thing. So we either better talk them off it, or we got to be ready for the repercussions of not giving the market what they have priced in. So 80%. So you might say, is September fully discounted? No. Is November fully discounted? Not. I would say November is, because if I look at cumulatively the 50%, and the 25% rate cut expectations, meaning 125 in November or the second 25 in November, cumulatively they're over 80. So yes, by December, November, they better cut. That is priced in. But then that takes us into next year where there are more cuts expected. Gang, it's not just about this race to the end of the year. We are still going to see a dovish Federal Reserve based on Fed fund futures, based on the data going into next year. All right. What will happen if Powell hints at rate hikes? Trader Momo, I don't want to talk about things that are in no way backed by data or by previous comments. So he could say anything, right? He could say he likes pineapple on his pizza. I mean, that's a reason enough for me to sell the market off. He's not going to. I can say a lot of things pretty confidently. He's not going to. In fact, he's gone out of his way to correct a lot of the hawkish talk that happened in April of this year. He's actually said in clear English, we are not considering rate hikes. So I would not in any way factor that in. And if I can't play the what if, because what if he does, then what? Right? Of course, we're going to end up with a lot of chop. But Trader Momo, I would not in any way expect that. Next up is Natty Gas. What do we think about Natty Gas? Can we sell this pop? Well, red candles reaching the gold zone is one of the setups. And so while we don't have a downtrend in Natty, it certainly is. Why me? It is bearish. Red candles are bearish. And these aren't your generic Japanese candlesticks. They're red, yellow, and green. Green candles are bullish, yellow candles are neutral, red candles are bearish based on price and participation. And so, yes, if you would like to consider a short in NG or puts in UNG or puts in even the NG futures, red candle meets the gold is a setup. I haven't been really focusing on the short side of energy, but yeah, that would be completely valid. Christine says, could I get my input on SMCI on the hourly? Sure. So SMCI, heavily weighted stock in the Russell. It is not weighted in the semiconductors, by the way. This is not a semiconductor play. This is its own play, and it's a small cap play. So next Friday, as in a week plus from today, I always see next as in not Friday, this Friday. Give me the date for sure, because if you're talking about Friday, to me, next Friday means the 19th versus the 12th. If you have options for the 12th, the hourly is a fine thing to look at. But if you have options for the 19th, I would not look at the hourly in any way for expectations. I'd keep an eye on the daily, in which case, I want to stay bullish as far as where your strike is or where you've bought it. I would stay bullish. And if the broader averages can rally, namely the Russell, we could see another shot at, say, 975. All right. Okay, next up is 19th. Okay, so next. All right, you define it just like I do. Some people say next Friday, and they mean the one that's coming up in a few days. I just wanted to be sure. Keep it on the daily. The hourly is too short a time frame to manage that many trading days for me, Christine B. So, yeah, I would stay bullish. Again, the target, I can only give you where resistance is going to be. Your trade plan would probably have your risk and your target factored in. But I would say, that area around 970, 975, and then an area right around 1015 would be upside resistance. And if we can keep moving higher, I would look to take profit into those prices, not necessarily into that date. All right. Next up, thank you for the question, is AMD. Sure. So AMD surged, but it's not one of the stronger names in the semiconductors. I would still favor the steadiness of green candles in NVIDIA, Taiwan Semi, ABGO, ASML, AMAT, LRCX, even TXN. I would say AMD and Intel are kind of the same thing. They just recently surged through some resistance levels. Be careful with that. I'd rather be in a more established looking trend or even an established looking bullish chop on TSM. But ultimately, if you're looking for AMD and out into August, oh gosh, Eddie, I mean, be bullish, but I have no idea where we'll be in August. I'm just trying to get through today and this week and the data. Generally speaking, if the trend in the semiconductors is up and the trend in the NASDAQ is up, something like AMD, which has been a laggard, should continue to participate and arguably potentially play catch up. All right. So in terms of semiconductors themselves, I'm a big fan. So John, the alignment is there. Semis are still bullish. They're not in the trend that they once were. Semis are going to track with the NASDAQ. Semis are still one of the strongest sectors, not just for this month, the last 30 days, but for the year. For the second quarter forward. So for the second quarter forward. And if NVIDIA and Taiwan Semi and AVGO can continue to move higher, these are your top 3 weighted stocks in SMH. If those 3 names can continue higher, there's no reason semiconductors shouldn't, right? But I would want to pull back before I do that. Okay. All right. Gold versus crude. If I'm playing a game of trade this, not that, I probably wouldn't contrast these two. They move for very different reasons. But in terms of just strictly, to your point, Java, just strictly market structure analysis, I prefer gold to for chop. If you're looking to play a choppy type setup, gold. But if you're looking for a trend, I would focus on crude. So it depends on what you're looking for. You know, some folks are waiting for momentum breakouts, or they want an oversold buy. That would be gold. If you're looking for trends, crude, and I like trends, so it'll be crude for me. All right. Let's see. Bear with me here. LRCX. I always find the spreads in LRCX are too wide. Walter, so for me, a wide spread is going to be greater than 10% of the bid. So whatever the bid is, if the spread is wider than 10% of that value, that to me is too wide. So I don't know what your measuring stick is, but in terms of the second part of your question, what has your experience been with spreads and open interest? Volume is cumulative. Remember, we start off with 0 every day. So I'm not really concerned about options, the option chain and volume. In fact, when I look at my option chain, volume isn't even represented. I don't worry about the volume. But to your point, open interest. The less the open interest, the wider the spreads typically. And that's going to matter mostly to folks who buy options, not folks who sell them. So if you're a buyer of options like myself, then open interest is a really big deal. And I would like to see the higher open interest typically maps to a narrower spread, but also the first 10 or 15 minutes of the morning, those things are sorting themselves out. So you might see wonky spreads in the opening moments after the bell. But for the most part, yeah, I focus on open interest. And then that is what usually gives me clarity into participation. And yeah, usually we'll have a reasonable bid that's at least less than 10%, reasonable spread that's at least less than 10% of the bid. All right, gang. As always, thank you so much for being here for Charts and Coffee. I'll see you all tomorrow. Same time, same station. Be good to each other.